Hello everyone, it's Professor Reiko. This video we're going to walk through different types of dividends. All right, so if you see up here at the top of the page, we've got 4 different types listed: cash, property, liquidating, and stock. All right, the most common is obviously a cash dividend. That's what most companies pay, but there are a few exceptions that we'll go through as well. All right, now remember, not all companies pay dividends. Okay, so dividends are it's a good if you can start paying a dividend and continue to pay a dividend for a number of years. That's a very strong market signal. A lot of people that are nearing retirement like to invest in companies like that because they know they're going to have that quarterly dividend coming in the form of cash flow to them. So there's pros and cons to paying a dividend. And, if you're a growth company, you don't really want to pay a dividend because you want to use all your cash to be inventing and growing and coming up with the next cool stuff. All right, because remember, so dividends. So let's just write this out. So dividends affect retained earnings. So ending retained earnings equals beginning retained earnings, what we started the year with, plus net income. And remember, income and earnings are the same thing, minus dividends. All right, so dividends are thought to be earnings that are not retained within the company. They're earnings that are distributed to their shareholders. Okay, so they reduce retained earnings. All right, so a couple important dates here. Date of declaration. All right, on this date, we are going to record the payable. Okay, companies become legally liable when they declare a dividend to pay it. All right, the date of record just means all shareholders as of this date will receive the dividend. There's no journal entry for the company on this. And on the date of payment, they just reverse the payable and send out the checks. Okay, so the accounting is not terribly difficult. All right, so let's walk through just a basic cash dividend here. So we have a cash dividend that's going to be paid. It's announced or declared on June 1st. Paid on July 1st to stockholders of record of June 15th. Record all the appropriate journal entries. All right, so on June 1st, we're recording the dividend. All right, so there's a couple of different schools of thought here. All right, so you can debit retained earnings, or you can debit dividends declared, or even just some people might just debit dividends here. Okay, so that is 100,000. And then this is just be dividend payable, which is a liability for 100,000. All right. So for me, I know a lot of books use the dividend or dividend declared, and that's fine. And the reason they do that is because if you think back to, I don't know, it's probably chapter 2, 3, or 4 in your book where we did the accounting cycle, and at the end we do the closing journal entries. Remember, if you debit dividends here, okay. So right here, if you had a debit to dividends, at the end of the period, you would close this account out with a credit, and then you would debit retained earnings. All right, because remember, up here, dividends reduce retained earnings. I typically just take it directly out of retained earnings when I'm recording the dividend. That's my personal preference. And then I wouldn't have to do the closing entry at the end of the period. But, if we're walking through the exact process of the book, teacher might prefer you to go with dividends here and then close dividends out at the end of the period. So just make sure you understand that. But the reason I can also debit retained earnings here is because remember, retained earnings is an equity account. So a debit to retained earnings reduces it. And that's what we say up here. Dividends reduce retained earnings. Okay, so that's kind of my logic behind it. So obviously, you always want to make sure you understand what your professor wants from you in this type of example. All right, July 1st, we pay it. And so we just take the payable off the books and cut the checks. All right, so as you can see, nothing terribly difficult about doing that type of dividend. All right, so let's move on to the next type of dividend. This is a property dividend. All right, so these are less common, although I've actually received a property dividend before when I was invested, I think, in Verizon a few years back, and they instead of paying cash in their quarterly dividend, they gave out shares of Frontier Communications that they owned. Okay, so it was kind of random, but so it does happen. All right, so this is just a distribution that is payable in some asset other than cash. So in the example I just gave, I received stock that they owned of another company, so it would have been an investment to them. All right, so these should be recorded at fair market value. Okay. And a gain or loss should be recognized for the difference between the carrying value of the asset that they're distributing and the fair market value of that asset. Meaning so it's going to be just like we did on the previous page, except we have one extra step. the first thing we're going to do is mark the asset up or down to its fair market value. So let's look at this example over here. We've got a company. They own 200,000 shares of another company. The carrying value is 250. Okay, so that's what it's on the books at now, their investment. The current market value is 300, which means we're going to have to mark it up from 250 to 300,000, right? Because that's what they're going to distribute. So let's just start with that, okay? So we have it's on our books at 250. We want to record this dividend at 300,000. So what we're going to do is increase. We'll call this equity investment, or you can call it investment in equity, investment in stock, whatever you called it when you do your investment chapter. All right, so equity investment, and then they'll call this an unrealized. Sorry, there, I just lost my messed up there a little bit. That would be unrealized holding gain or loss. So this is going back to your investment chapter, so you might have to go back and revisit that, and that would be going to net income. Okay, so it's still on the income statement. It's unrealized because we haven't sold it yet. So what we're doing here is we're marking this up by 50,000. Right. So if you think about the equity investment, let me squeeze this over here. It was on our books at 250. All right, we just increased it by 50, so that's that 50 right there. So now it's on our books at 300, which is the market value. Okay, so now we're ready to record this dividend at market value. So we can do retained earnings, or you could do dividends declared again here, and property. I'll just call this property dividends payable instead of dividends payable. All right, and we'll record that at market value, which is what it said to do on the previous page. All right, so you see we just have one extra step, but after this first step, then we're just ready to go. So then when we pay the dividend, we'll take the payable off the books for 300,000, and make sure you don't put cash here. We're taking the equity investment off the books, because remember, that's what we're giving out as the dividend. So if we if we put that up here, 300, and then that account is now 0, but that's what we want because we just got rid of all of it. All right. All right, the third type is a liquidating dividend, and then we'll jump ahead to stock dividends and then stock splits in the next video. All right, so liquidating dividend, these are less common. You don't hear too much of these, but if you look at that formula I wrote on the previous page where, dividends reduce retained earnings because they're thought of to be from earnings, and that's what it's saying right here. If the dividend comes from something other than earnings, it must be classified as a liquidating dividend. So how do we handle that? Okay, so they're accounted for by reducing paid-in capital because they're considered a return of a portion of the stockholder's investment. All right, so let's look at how we account for this. It's not that tough, but let's just walk through it real quick. So they have a dividend of 100,000. Noted that 70,000 should be considered income, and the remainder a return on capital. So 30,000 is the liquidating dividend. 70,000 is a normal dividend. All right, so on the date of declaration, I'm going to debit retained earnings for the normal portion of the dividend. I'm going to debit additional paid-in capital common stock, or some paid-in capital account for 30,000. That's the liquidating portion. And then I'm going to credit dividend payable for 100. All right, and then when we pay it, we don't have to do anything special. We just take the payable off the books and credit cash for the 100. All right, so all of these dividend type questions here are great multiple choice questions. You can see they're not very long. They're not really that tough. You just need to make sure you keep it straight. So, cash dividend is pretty straightforward. When you do the property dividend, remember, you have to add in that first step to increase or decrease your asset up to its market value. And the liquidating dividend, just make sure for the liquidating dividend portion, you're reducing paid-in capital. Remember, paid-in capital right here. Remember, it's a normal credit balance, so that debit to that account reduces it. So so just make sure you kind of keep all the unique characteristics of each type of dividend straight. All right, so next video we'll go through stock dividends and stock splits, and then we'll be close to wrapping up this chapter. So just stay tuned for a couple more videos, and we'll be done with our equity chapter. All right, see you next time.